Hey everyone, this is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in today's video, I'm going to be doing something a bit different here. I'm going to be walking you through live how exactly I'm going to be trading the Twitter earnings announcement. And this video is being recorded on February 9th, 2021, and the earnings announcement is coming out today after the market closes. And so right now it's 2:10 p.m. Central Standard Time, so that would be in about 50 minutes. Once the market closes, then the earnings announcement figures are going to come out. And so the way I trade earnings announcements, specifically with options, is I really do not care where the stock actually goes once those figures actually come out. And for the most part, what I have seen trading earnings announcements many times at this point is that it's really a 50-50 shot whether the stock goes up or down. I've seen it plenty of times where the earnings figures are great, they're better than expected, and the stock plummets the next day. And then conversely, I've seen the numbers come in well below the expectations and the stock skyrockets. So there really is no edge in trying to guess where the stock is going to go in terms of the direction based on the actual earnings figures themselves. And so as an options trader who trades purely off of probability, the way I trade earnings here is I'm basically betting that the stock is going to stay within an expected range once those numbers come out. And this expected range includes either an up or down movement. Like I said, I really don't care whether the stock moves up or down. I just want it to move either up or down, but within an expected range. And this expected range comes directly from the option prices. And specifically, if we go to the trade tab here, and then you can see this number right here, 7.44, based on the option prices for Twitter, this is the expected move either up or down for Twitter stock over 1 day. So if Twitter is currently trading for about $60 per share, then 1 day from now, after those earnings figures come out, the market, based on the option prices, is expecting Twitter to either be up or down by about $7.50. So the range here, the expected range, is below 67.5 and above 52.5. So like I said, ideally I want Twitter to remain within that range, and also I would like the implied volatility for Twitter to contract significantly. This graph down here, this graph shows you the implied volatility levels for Twitter over the past year. And in case you aren't aware, implied volatility is simply the market's expected range for a particular stock over a 1-year period. So you can see right now the implied volatility for Twitter is just under 86%. So this is saying as of right now, today, the market is expecting Twitter stock to be either up or down a year from now by almost 86%. That's a huge number. And you can see looking at the past, the implied volatility level for Twitter right now is very elevated compared to where it's usually been over the past year. The majority of the time, the implied volatility for Twitter is usually somewhere around 45 to 50%. And typically what you will see around an earnings announcement is you will see a spike or a significant increase in the implied volatility levels. And this is simply reflecting the uncertainty about those exact earnings figures. And so then once those earnings figures come out, once the uncertainty is removed, you will very likely see a quick contraction in implied volatility thereafter. And so if you've seen my other YouTube videos on implied volatility, or maybe you've seen some of my SKILLSHARE courses, then you'll know that implied volatility has a very significant impact on the prices of options. Specifically, as implied volatility expands, that's going to dramatically increase the value of all the options. And then conversely, when implied volatility contracts, that's going to crush the prices of all the options. And since I'm an option seller, I want to sell these options when the price is very high, when implied volatility is very high. And then I want to buy them back when they're much cheaper. And then I can make the difference in prices, the difference in price from where I sold it and where I bought them back, I make that difference as profit. And so what I'm going to do here is I'm going to sell an out-of-the-money call option and an out-of-the-money put option at the same time. This is going to be what's called a strangle. And I'm going to sell these options with strikes well beyond the expected 1-day move, right? Which, as you saw on the trade tab here, the 1-day expected move is $7.50. And this number comes directly from the implied volatility levels of Twitter, and the implied volatility comes from the prices of options. So that's the full picture there. So ultimately, when these earnings figures come out and Twitter moves around, if it stays within this expected range, or even if it goes a little bit beyond it, and there is also a significant contraction in implied volatility, this is going to be a very profitable trade. And the reason why I want it to stay within the expected range is because I'm selling both a call and a put at the same time. So if Twitter really moves in one direction or the other, it could blow through one of my strikes, and that would definitely be a loss. Or it could still move beyond what's expected for tomorrow, enough to actually counteract the contraction in implied volatility. There's no doubt in my mind that the implied volatility levels for Twitter are going to contract significantly after tomorrow, and that's going to work for me as an option seller no matter what. But like I said, if Twitter stock still moves enough beyond the expected range, that could offset the benefit to me of implied volatility contracting. So of course, there is definitely some risk to doing this, but there's always going to be risk to anything that you do in the stock market. You cannot make money without taking on some level of risk. It just makes sense. But I'm still going to do this in as safe of a way as possible. So I'm going to go to the trade tab here, and I'm going to go to the March expiration options. These options expire on March 19th in 38 days. So selling these contracts will give me a lot of time baked in the event that Twitter does move actually way beyond the expected amount. There are adjustments and other things I can do to help keep this trade alive so that I can basically hang on to it in the hopes that eventually Twitter actually does come back around in my favor. So that's why I do prefer to give myself more time in terms of choosing an expiration cycle at least 30 days out from today. Moreover, choosing an expiration cycle with a decent amount of time baked in will allow you to sell options that are very far away from the current trading price of the stock and still collect a decent amount of money. So for example, what I'm considering doing here is selling this call right here. This is the 85 strike call option. And you can see I could sell this one for about $93 or so, and it has a 13 delta. And then on the put side here, I'm probably going to sell this 46 strike put option, which is trading for right around $100, and it has a 12 delta. So I'm leaning ever so slightly bearish here. I do like to play these earnings announcements with a pretty neutral bias, so these deltas right here pretty much cancel each other out. So like I said, I'm really just playing for Twitter stock to stay within this expected range. I don't care if it moves up or down because I'm totally delta neutral here. I'm simply trying to profit off the contraction of implied volatility. That is the main thing I'm trying to do here. Now, one thing I like to do here before actually pulling the trigger is I do like to see what the expectations are for this Twitter earnings announcement, just so I can have that awareness, and potentially if I see something surprising or a bit out of the ordinary, that might influence how I place my strikes. So for example, I can go to the Yahoo Finance webpage here. I already have Twitter stock pulled up. I can go to the Analysis tab, and then if I scroll down a little bit here, you can see this earnings announcement table. And right now you can see the average estimate is 31 cents per share. This would be the expected earnings per share that is being projected by the market at this time. You also have a low estimate as well as a high estimate, but using the average, basically in between, is good enough. And you could see the same earnings figures for exactly 1 year ago, and in this case it's 25 cents per share. So Twitter is expected to do a little bit better this year than last year at this time, but really not by much. I mean, the difference here is literally 6 cents per share. It's almost nothing. And if you come back to the charts here and take a look at Twitter, this thing has absolutely skyrocketed in the past few weeks. Now, like I said, it really is a matter of a flip of a coin whether Twitter is going to move up or down once these figures come out. But because Twitter has rallied so much already, even if the earnings figures are at expectations, they're better than this time last year, or even if they exceed expectations and Twitter stock does go up a bit higher, I'm not really worried about some huge explosive move to the upside. It certainly could happen. There's no way to know that. But based on my experience in the past, there's usually not a whole lot of surprise with big established companies like Twitter or Apple, Facebook, etc. And so for this reason, and also the other reasons I just laid out, I don't mind taking on some upside risk by selling that out of the money call option. But just to be on the safer side, that's why I'm choosing the 85 strike call option, which is $25 away from where the stock is currently trading. Very, very far. And actually, if we go back to the charts here, and we go to a max view of Twitter, you can see the highest point this stock has ever been in its entire history is only just under $75 per share. So Twitter is going to have to exceed its all-time highs by another $10 just to even test my short call strike. Of course, it could happen, no way to know, but I would view that as pretty unlikely, at least in the short term. And then coming back to the daily view here one more time, And so I'm also going to sell, as you saw, the 46 strike put option, which if I zoom in a bit here, 46 is right there. So this also gives me plenty of room to the downside in the event that Twitter has a pretty big fall. And given that it's already so extended, I wouldn't be surprised if it did come down in the very near future. And so that's why I've decided to place my put strike below the 20-period moving average and also as close as possible to this support level right here, which is coming in right around $44 or so, 44.5. So selling a put option with a strike of 46 is pretty darn close. Ideally, I would like it to be below this support level entirely, but in order to remain delta neutral, in order for my deltas here to cancel out, that's why I have to sell this 46 strike put. If I were to sell the 44 instead, this one only has a 9 delta, and if my call still has a 13, then overall this strangle here would have a slight bearish bias to it. And honestly, I don't mind being bearish with Twitter given that it has rallied so much, but because this is an earnings trade, I do still like to be pretty delta neutral. And also selling this 46 strike put allows me to take in even more money than selling the 44 strike, right? I can set up this order now. So right click, hit sell, we'll go to a strangle. So I'm going to sell the 85 strike call and the 46 strike put right here. And you can see I can sell this strangle for almost $200, which for a stock trading at 60 bucks is pretty darn good. And again, this is because the implied volatility for Twitter is so elevated right now. But like I said, hopefully once these earnings figures come out after the market closes, and then once the market reopens tomorrow and trading resumes, all of that uncertainty will go out the door. Everyone will know what's going on with Twitter, and those implied volatility levels will get annihilated. And so the last thing to do here is hit confirm and send, and then I'm going to check the buying power effect for selling the strangle. This is the amount of capital I have to set aside and have locked up while I'm in this position. And you can see it's right around $600. And generally I will not allocate more than 5% of my entire account value for one position. One of the biggest things I harp on in my videos and in my courses is to stay very small on an individual trade basis, meaning only allocating between 1 and 5% of your entire account value for one position. And so given that 600 bucks is less than 2% of my entire account value, I'm very comfortable setting aside this amount of capital to hold this position. And so finally we hit send here. And it looks like I have not gotten filled quite yet. Let's go to the monitor tab. And you can see my limit price is at 196 and the strangle is currently trading for 195.5, so now 194. So my price might be a little bit too high. So what I can do is I can right click and cancel and replace this order. I'll come down to 195. Let's see if I can get filled here. Send. Not quite yet. I guess the buyers out there really want me to pay up a little bit to get my order filled. So let's go down again, cancel, replace. The mid price for this is 194, so I'm just going to go down to 190 and hopefully I just get filled at a better price. So hopefully one last time, confirm and send. And there we go. So I got filled at exactly 190. Not exactly ideal, but of course, like I said, because I'm doing this live and with the market closing soon, I do want to be in this position. And so now at this point, since I am locked and loaded, all I have to do now is wait about 20 more minutes. Hopefully Twitter does not go crazy, and then tomorrow morning, once the market opens up, we can take a look to see where the price of the strangle has moved. Hopefully it will drop significantly, but if not, then you will see what I will do with this trade. As I said earlier, I do have some other options in terms of managing and adjusting this trade and holding on to it in the hopes that eventually I can get out for a nice profit. And alright, so it's about 2 hours and 45 minutes after the market has closed. At this point, Twitter has made its move after the earnings announcement came out. And so I do have the Robinhood charts pulled up here. I do like to use the Robinhood charts just because the UI is so clean, and plus for earnings announcements, you get a very clear picture of how the stock is kind of bouncing around and it's kind of fun to watch. And so you can see after hours, the move of Twitter was only $1.21. Keeping in mind the expected move was actually $7.50. So this is a tiny, tiny little move compared to what was actually expected to happen when these earnings figures actually came out. And this is exactly what I was hoping for. I don't care whether Twitter moved up or down. In this case, it did move up by just $1 and about 12 cents. Again, all I care about is that it moved within the expected range. And ideally, the less it moves, the better. And then come tomorrow when the market opens, hopefully we get a very nice and significant contraction in implied volatility. I think that's very likely given that the stock moved so little. And as a result of all this, I expect to have a nice profit on my hands. So we'll see in the morning. Alright, so it is now the morning after the Twitter earnings announcements came out, and the market here is going to be opening up in about 8 minutes or so. And if we come over to the Robinhood UI here, we can see in the pre-market trading, Twitter is up now almost $6, which is a bit unfortunate. As you saw after hours yesterday when the market closed, Twitter was only up about $1.20. So this extra move higher this morning may actually work against me a bit here, but still keep in mind the expected move for Twitter was $7.50. So 577 is still within that expected move. So hopefully this, coupled with a nice implied volatility contraction, will still give me a profitable trade this morning. But if not, or if it's only profitable by a little bit, then I can just continue to hold on to this trade and let time decay do its magic and decay the value of the options I sold. Plus, sometimes implied volatility does not contract all the way just in one day. Sometimes it happens over several days. So point being, once the market is open and after a few minutes, once trading resumes and the markets tighten up a bit, then we will see how profitable or how not profitable this trade will be the morning after the earnings announcement. And one thing to note here, I did also sell a strangle on General Motors yesterday as well. They also announced earnings this morning, pre-market. And so if we go to GM here, go to GM, we can see it only moved 19 cents. And I believe the expected move was about $2.50. So this actually may be a bigger winner this morning as opposed to Twitter. So we'll also just have to wait and see once the market opens. Alright, so the market is open right now, and we can see from my Twitter position right here, this is the strangle. Looking over at the P&L open, just a few seconds after the markets have opened for Twitter, I'm already up about $30 on this position, and now it's about 54, so I'm just going to wait a few more minutes. Hopefully once the markets tighten up a bit and there's more activity, we'll get to see more of an implied volatility contraction and hopefully some bigger profits here. And if I do go to the charts here for Twitter, let's see what we got going on here. Yeah, the implied volatility hasn't really contracted much yet. And you can see Twitter has kind of taken off here a bit. This is a pretty big move. So I don't expect the strangle to be that profitable this morning at least, but we'll see. So let's come back to the monitor tab here, and I'll just keep an eye on this one for a few more minutes. But I hope you can at least see already that just in one day, just the morning after these earnings announcements came out, we did get some implied volatility contraction immediately, right after the market opened. And already this position is up by about $50. And now at this point, Twitter is taking off a bit. It's going a bit higher. It's up about $8.75, so that is cutting down on the profits right here. Now normally, when I do sell a strangle or sell a naked put or naked call, I do like to take my profits at 50% of the maximum. So for example, I sold this strangle right for $190. 50% of that would be $95. So ideally, I would wait until this strangle here is profitable by $95 before I take it off and exit for that amount of profit. Now because this is an earnings trade, and I'm mostly trying to profit off the contraction of implied volatility the morning after, I do tend to take these winners off early before I hit that 50% mark, but only if I'm close to that 50% mark. As you can see right here, being up only $40, that's a little less than half of the $95 I would want to make on this position. So because this is only about 25% or so of the initial credit I sold this strangle for, I'm not going to take it off quite yet. I'm going to hang on to it for a little while and hopefully Twitter comes back down a bit. And if that happens, then hopefully the profit on this position will hit around that $95 I'm looking for, and I can take it off for a winner. And let me actually go to the trade tab here and check my deltas on these options. So here's the call that I sold. Here's the put that I sold. You can see the call has a delta now of 16, so it has increased just a tiny bit. And the delta on my put here has gone down pretty significantly to only 4. So adding these deltas together here, the overall delta on the strangle is positive 13 now, which is still very, very small. This is definitely a more of a bearish strangle now, which I don't mind because Twitter is exploding a little bit right now, and it's up already so much in the past few weeks. So definitely don't mind leaning a bit bearish with this strangle here. I still feel very safe with the call here at the 85 strike. It's still very far away from where Twitter is trading, and like you saw earlier, the highest Twitter has ever been in its entire history is only 75. So let's come back to the monitor tab again, and we can see right now, okay, the profits have increased a little bit. I'm currently up by $52. Still going to hold on to this one for a little bit longer, but I hope you can at least see the advantage in selling options when implied volatility is very elevated. Because even if the morning after you have not hit your profit target, the contraction in implied volatility, ideally after an earnings announcement, will definitely give you a nice head start. So if I can't take this one off today for that $95 profit that I'm looking for, or around that point, then literally maybe in just a few more days, I can hit that profit point. And so this kind of strategy, selling out of the money options when implied volatility is elevated, this is how I generally trade across the board. And it looks like I just closed one of my TME positions, one of the naked puts I sold. That's pretty cool. Looks like I also closed my EWW naked puts as well. So I did take some nice profits here. But like I was saying, this is how I make all of my trades. I sell out of the money options, either just naked puts and calls at the same time. Sometimes I do defined risk with iron condors or put spreads, call spreads, etc. These are all high probability of profit trades that take advantage off the contraction of implied volatility and time decay. And as you can see here, the vast majority of my positions right now are very profitable. This Momo position, unfortunately, this is actually not the real P&L for today. I'm not actually down by $374. If I go to Momo, for example, you can see that the markets are just super wide on this call option that I sold. The bid is 19 cents and the ask is almost $4. I'm not sure why only this option has such wide markets, but in reality, if the markets for this option actually were pretty tight like the rest, I actually would be up on this position. So you can basically just ignore this one. And there you go. Looks like I closed my other TME naked put as well. So that entire position is now closed for a profit as well. And in case you're wondering, I do have GTC orders that take profits automatically. That's why this stuff was happening without me even doing anything. So anyways, I'll keep you posted on what happens with this Twitter trade here. I'm going to keep checking on it periodically throughout the day, and I'll let you know what I decide to do with it. Alright, so a final update here for this video. Twitter did come back down to earth a little bit, which is a very good thing. And so the profit on the Strangle right now has gone up to about $77 or so. Although as you can see, it is definitely fluctuating a little bit. So like I said, I would like to wait until the profit here is at 95, 50% of the credit that I sold the Strangle for. But again, because this is an earnings trade, and these are meant to be rather quick trades, just trying to capture the contraction of implied volatility, which if we go to the charts now again, you can see the implied volatility for Twitter is still elevated compared to the past year. But now you can definitely see it has collapsed quite significantly here just this morning. So this contraction right here, combined with Twitter backing off a bit and coming down from the highs of around 69 to down to about 65, this is what has allowed this Strangle here, this position, to be profitable by a pretty significant amount just in a few hours after making the trade. So I'm going to go ahead and close this trade now for a profit. I expect to make right around $80 or so. So I'll go ahead and do a right click, create closing order. Going to buy this Strangle back. You can see the mid price is right around 110. So let's see if I can get filled right here. Confirm and send. And there we go. It got filled at exactly 110. So I'm officially out of this Strangle on Twitter. And so because I sold this Strangle for $190 and I bought it back for 110, that is a profit of $80 minus a few bucks in commissions. But overall, I would say this is a very successful earnings trade. And hopefully you found this to be a very interesting way or approach to actually make money off of earnings announcements, in that not only are you able to profit without getting the direction right of where the stock actually moves after earnings, but you don't even have to care about the direction in the first place. It's simply all about taking advantage of implied volatility and what the market expects Twitter to do. And what you'll find, and you can watch my other YouTube video called Implied Volatility, the reason why I only sell options. I'll post a card above linking to that video. And basically the market's expectations for what stocks will do, either over an earnings announcement or just over a normal week or over a month, etc. Those expectations are usually overstated. And this happens the vast majority of the time. And you just saw an excellent example of that this morning with this Twitter announcement. The expected move was up or down by $7.50, and as of right now at least, Twitter's only up by $4.35, well within that expected range. And so that's why trading earnings in this way, selling out of the money options, and this also works for non-earnings announcements as well. A lot of my positions here are actually not earnings trades, but point being, that's why this style of options trading actually works over the long term. You are taking advantage of the market's consistent overestimation of what certain stocks and ETFs are going to do during specific events or over a certain period of time. And during a typical earnings season, I might make 20 or 25 of these kinds of trades. Now, of course, they're not all going to be winners like this Twitter one was, but because these are all very high probability of profit trades, the vast majority of them will be. So if I make 20 trades like this on various earnings announcements during a specific quarter, maybe 15 of them are profitable and only 5 are not. And so then adding all of them up together, the wins plus the losses, I might still get to walk away from this earnings season maybe with a $1,000 plus overall profit. Maybe I make $1,500 on those 15 winners. I lose 500 on those 5 losers, so net net, I still walk away with $1,000. And that's just for my earnings trades. Like I said, a lot of these other positions I have here are just normal positions, and they all function in a very similar way too. And lastly, I almost forgot about my GM earnings trade. You can see right now I am down about $16.50, not a big deal. And this is because GM has actually moved down beyond its expected move, or its expected range. So no big deal. I'm going to hold on to this trade for a little while longer. Hopefully GM bounces back, implied volatility keeps contracting, time decay keeps working as the days roll by, and hopefully at some point in the near future I can get out of this trade as well for a nice profit. So with that being said, that concludes this video. I know it was a bit of a long one, but I hope you found this kind of video very interesting to watch. This is my first time actually recording a live trading session that I've done, and of course I am glad that the Twitter earnings trade actually did work out, but even if it didn't, you would then at least be able to see how I would actually manage and adjust this trade to keep this position alive. And perhaps I'll make more videos on that specific topic in the future. So thanks for watching this video, and if you enjoyed it, please do me a favor and hit the like button and subscribe to my channel. It would really help me out a lot. And with that being said, I'll see you next time, and happy trading.